India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's Tuesday morning in this holiday-shortened week. Yesterday, of course, was all over the place and finally a flat close. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning.
Hi, guys. Morning. I think that's a very important cue. It's a holiday-shortened week. I'm going to hold on to that as we start.
Well, that's right, but plenty of action today. You have the MSCI rejig. You have crucial economic data coming out of the United States later this evening. So we have got our hands full. Prashant, go for it.
And we have very good inflation data.
Absolutely,
which I think is important, very important, because, we are tied at the hip, of course, to what the global central bank cycle is, which is what the Fed really initiates. But, you need to have comfort here on inflation as well. And that is sort of cooled off. And we'll talk more about that. But let's begin where we left off yesterday. So we yesterday had a sort of swinging kind of a day, right? I mean, the market sold off right at the word go. There was a sharp recovery, almost 250, 275 point recovery from the day's low. And then there was another sell-off, which took us back to flat zone. So absolutely nothing by close at about 24,347 on your screen. But I must highlight that there were lots of at least 10, 12, 15 big mid-cap moves, both up and down. I'm talking about 7, 10, 15% moves up and down based on specific news flow, earnings and otherwise. Actually, it was mostly earnings, some from last week, continuing action, and of course, some which came through yesterday. And we'll discuss some of these stocks a little later. So it was a really vibrant market. It was not one way up, one way down at all. Overnight, it's been flat close. I mean, zero change on S&P, so that flat. The Dow was down about a third. Nasdaq was down about a quarter. Nasdaq was up a 0.25%. 3 out of 11 sectors ended in the green. Only 3, I should add. So it was actually pretty mixed out there. Nvidia was up 4%, and this AI-focused sort of stocks did a little better, but that could just be pullback because they're all on an average down about 18, 19% from their recent highs. There was a Fed survey which came through which showed increased consumer balance sheet stress. It also has a component which measures inflation expectations going forward, and that came off sharply. So, the consumer is weakening a little bit, maybe at the margin, and you got inflation expectations coming off. Not exactly the worst data. As I've been saying, markets very focused not on inflation anymore, but really on the health of the consumer and how fast that is deteriorating or not. Now, the 10-year lost about 3 basis points. Dollar index was down about 0.14. So these are not big changes, small changes. Oil had a big move. It shot up 3%, and this is on back of geopolitics. The Israeli military essentially announced that they are going to their highest state of alert. And, there have been lots of news reports saying that how they're anticipating attacks from Hezbollah and other parties there. So geopolitics really up there and pushing oil prices to about 81.88. By the way, on I think WTI, we are already past the 100-day moving average. It's taken that out. So that is oil. Spot gold prices, I think, on the back of some of these geopolitical concerns, also went up about 1.5% or so, which then gets us to the environment for the market here. It's a little mixed still. Look at what's happening around you, around Asian markets. I think Japan, which was shut yesterday, is trading. It's up about 2% or so, maybe a little bit more. But other markets broadly are all kind of flattish. Nifty resistance, basically 2 levels which the market needs to take out. One is the 20-day moving average, which now, as of yesterday's close, stands at 24,536. And then you've got the 24,625 level, which is the 61.8% retracement of the decline, a level we put out yesterday as well. On the way down, supports come in. Basically, the 2 swing lows, 24,080 and 23,893, which is essentially the absolute kind of bottom. You're basically looking at a ranged market. On the downside, around 23,900. On the upside, about 24,600. That's essentially broadly the range you're looking at. Bank Nifty saw another positive daily close, and it's outperformed what the Nifty did. but without really adding too much to the overall index picture because everything else was kind of weakish. Resistance here is the 20-day exponential average, which is 51,292. And then the 40-day exponential comes in at about 51,032. And on the downside, these are support levels, which I put out yesterday as well, 50,153 and 49,659. The GIFT Nifty will come up on your screen, indicating the kind of start. I mean, I think almost yesterday, same time, you had a similar kind of a picture, 36-odd point lower start, flattish kind of day, lots of pulls and push on both sides, which I think continues today as well. Really, it's about individual stocks and sectors, which we will get to in just a bit. For the index, as I said, kind of arranged in this broad zone. Surabhi.
Absolutely, Prashant. I guess we're starting with a bit of caution, but also some underlying optimism that, we're not looking at anything which is very negative in overnight cues. Just to the point on oil, so the rally, the geopolitical risk premium that kind of got built in, that took Brent up almost to 82. We're back at those levels. Remember when the whole global sell-off was happening, we were looking at Brent in the low 70s. So from that point onwards, there's been a very sharp recovery. The other mixed cue on oil, which is keeping a lid on further gains, is the fact that OPEC is not sounding very bullish on demand. In fact, yesterday, OPEC cut its own estimates in terms of oil demand by not too much, but about 135,000 barrels per day. So they're saying because of lack of pickup in the Chinese economy, they're not expecting demand to be as robust as when they had first given out this projection for 2024 back in July of 2023. So that's on oil. Let's quickly move on to flows, and not much has changed here. FIs continue to be on the sell side. Yesterday's selling picture was around 4,680 crores. As usual, domestic institutions are lapping up that exodus that's happening. So almost 4,500 crores of buying by domestic institutions. Just want to spend a minute on the macro cues because they're really important. And again, they're mixed. So IIP was not that great yesterday. The IIP growth in June is at 4.2% versus 6.2% month on month. So that's a bit of a dampener. The misses have really come in from manufacturing and electricity. Those are the two subsectors that have not fired up as well in June. But the big cheer is on inflation because for what it's worth, that headline number on inflation has fallen below RBI's 4% target for the first time in 5 years. 3.5%. That is what the headline consumer inflation number is reading. And it's a distance from the June number of 5%. However, before we start getting overexcited, economists will tell us that this is because of the high base effect. But again, I'm saying for what it's worth, it's a great headline. It's a positive headline. And food inflation, which the governor alluded to even in the last policy that just concluded, that's come off very sharply. Food inflation, vegetable inflation. So that's really good news. But of course, we have to see what happens once the favorable base wears off. In terms of post-market results, Vodafone Idea is going to be a talking point today for obvious reasons. The losses have narrowed a bit now from a loss of over 7,000 crores to at least 6,000 plus. The ARPU hasn't moved up much, but it hasn't fallen, so ARPU is steady. I looked at IRFC, considering the market's excitement around this stock. The numbers are very flat, so let's see if it manages to hold its own ground. Today's major results include Hero Moto, Hindalco, and Apollo Hospitals. That's on the results side. HDFC Bank is going to be in focus. We'll spend a lot of time talking about it because that MSCI weight increase is finally happening. More on that as we go along. But on a side note, I want to end with the tax collection numbers that are looking really healthy. Direct tax collection is looking very robust, 23%. But the number to note, look at the year-to-date collection on securities transaction tax, STT. That number has galloped over 110%. So, Nigel, guess who's having the last laugh? Government of India, really liking this.
All right. Well, let's get straight to trade action then. In today's trade, well, we have another weekly expiry that plays out. So you have the Nifty Financial Services Index. That'll play out the weekly expiry since it's a Tuesday. So that's one of the cues you need to track. Second up is going to be HDFC Bank. That's going to be the stock in focus. The MSCI rejig announcement, that fell short of expectations. So the stock could be a little bit subdued to start off with. But there are factors that will support it later on, which I'll get to in just a bit. And the third factor is once we are done with the trading session, we'll have to track the US economic data, which will be an important point as well. What happened in yesterday's trading session? On the Nifty Bank, there's about a short covering that we did see because the open interest out there was down by close to around 3%. Moving to the positioning then, how are the FIs as well as clients positioned? Well, they've not changed too much. So both of them continue to remain net long on the index futures, the FIs as well as the clients. And if you're looking at the FI positioning, it's almost split down the middle in terms of their long as well as the short positioning, almost at 50% apiece. Now, the problem is the Nifty is unable to sustain at higher levels. Yes, we're seeing the dips of the day get bought into, which is very encouraging. I think that strategy will continue as well. But from higher levels, we are seeing some selling. Even yesterday, we came up close to around 120 points. And in the last few sessions, every time we go to that congestion zone, which should come up for you on the screen, of around the 24,350 to around 24,500, well, we do see some bit of selling. So this is the congestion zone as of now. If we get past this level, then you're looking at the 20 DMA. And if we get past that, well, then the bulls will feel much more in control. On the downside, I think till that 23,800, 24,000 mark gets held out, well, then in fact, you still say that this upward trajectory does continue. So that's the line in the sand at around 23,800 because we have bounced from those levels as well. As I said earlier, the Nifty Financial Services Index will play out the weekly expiry, so that will be volatile in the second half of trade. Yesterday, it actually did quite well. HDFC Bank, that's going to be important. The MSCI outcome, well, it fell short of expectation, so that's a little bit disappointing on that front because now that entire rebalance will take place in two tranches, not in one that some part of the street was anticipating. The good news, though, is that there is a very low probability that the second tranche is at risk because it will require huge inflows to get past that FI threshold mark. So the second tranche, in all probability, happens, going by the data points that we have. The other clutch of stocks that I'll be looking at is the Adani Group stocks because of the MSCI comments on them. So that's why they've lifted the embargo on the treatment of Adani Group stocks. Yesterday, the stocks were a little bit subdued, but this is the positive news flow. And some of those that are part of a couple of indices are up for you on the screen. So keep an eye out on HDFC Bank. Starts off a little bit subdued. I think it gets support at lower levels. And Adani Group stocks as well. That's the other, clutch of stocks that I'm looking at.
All right. Nigel, thanks very much for that. Well, let's bring in some global opinion. Hartmut Issel is Head of Equity and Credit Asia Pacific Chief Investment Officer at WMUBS. He's joining us right now. Hartmut, great to have you with us here. Thank you for your time. Appreciate it. I just want to start with something which we don't talk about very often at all, and I guess for good reason, because it's not really had a big impact on markets, at least not equity markets, which is geopolitics. There seems to be a bit of a, at the margin, risk of escalation, both Middle East and Russia, Ukraine as well. Oil's up 3%, gold is up 1.5%. Just your first thoughts as you look at the situation.
Yes, absolutely. I couldn't agree more. These tensions, they're not going away. And if you look a bit deeper, you mentioned Ukraine war, for example. And so we've also seen instances of even all the way up to central bank asset freezing, only an isolated case, of course. But nonetheless, what we see as a conclusion for investors is that we like gold. And we like gold fundamentally, because you're seeing already the inflation coming off in the US enough for the Fed to really cut forcefully. And if the Fed cuts faster than inflation comes off, that's positive for gold, right? Because the competition from the rates is sort of diminishing. But yeah, we also see since almost 2 years now, the central banks, especially in emerging markets, are looking to diversify beyond the dollar assets. And naturally, gold is a choice that they will always look at. And also looks like they're not particularly sensitive even at which level they're going in, right? They want to do that diversification. So you have a couple of reasons beyond geopolitics. There's only one of them. So gold is really one of our preferred assets right now. And if I look into first half of next year, so the end of the first half, let's say we have a $2,700 target, which means you can look at almost 10% upside. So yeah, the answer to that question is, as an investor, you'd certainly look at gold at this point.
Okay, so gold looks like an interesting asset class. Got that, Hartmut. Let's talk about the other risks. So geopolitics is one of them. The other risk, obviously, that the market is grappling with is whether the central banks can steer the global economy into a soft landing, particularly the US, right? There's been so much debate about how many cuts will be enough and the timing of those cuts. If you do it too quickly, too often, then the market will get scared. If you don't cut enough, then will you get that hard landing? So where are you on that debate, and what do you forecast ahead for the US market itself as these cuts start coming through?
Yes, I think as also discussed on the program already earlier, the US economy is starting to soften. And the question is, does the Fed engineer a soft landing? We think, yes, that's the case. But beyond that, I would also consider the following. So if you look at what potentially is the neutral rate for the Fed, right, roughly as an indication, maybe 2% inflation, 0.5% real. So you're talking about 2.5%. we're multiple rate cuts away from that, until we're even neutral, let alone supportive, right? So what I would not underestimate for the U.S. market as well, that is the potential for the Fed, if they see, hey, things are slowing a bit beyond what we initially expected, they can cut faster. They're so far away from even neutral that I think can support the market. And long story short, also given that we see in the S&P already the first signs of evidence that the rally or the earnings growth, I should say, is broadening out beyond tech. So tech keeps, of course, good earnings growth, but other sectors are also starting to come back. So this is a picture where we think all else told, with the rate cuts also that we expect, 5,900 is the target, a pretty decent upside for the US here until the end of the year.
All right, Hartmut, what about the Indian markets? We have been outperforming, we have been falling relatively less, and on the way up, we've been doing better. Earnings visibility as well as there out here with solid domestic flows. Your view at current valuations on the Indian markets?
Yes. However, I'd say very, very near term, very tactically. As you rightly suggest, India hasn't really participated, virtually not, in this correction. So then also, of course, because we believe there's going to be a counter reaction in stock markets, so you have more upside. So if India hadn't participated that much on the downside, it's also a bit difficult to see how it would outperform when some of the other markets recover. Another point I would also say is that last year was a really bumper year, where Nifty at almost 20% earnings growth. So we're settling lower. As for this year, we have maybe 10, maybe slightly over 10%, something like that. It's still decent, right? But it's no longer 20%. So long story short, also tying in the valuations, as we all know, they're not particularly cheap at this point. Right? It could be that we're seeing a bit of a break, or at least a slower trajectory. So I'd say over maybe 6 months or so, perhaps expect something in line with earnings growth. So give and take maybe a 5 percentage points or so upside. But yeah, we have been a bit spoiled recently. Maybe the trajectory is a little bit flatter from here.
Yeah, I think that's the best way of putting it, right? We've been a bit spoiled, but let's see what this market can throw up. You're saying maybe another 5% from here. Good conversation, Hartmut. Thanks very much. You have a good rest of the day. Well, let's get you one more earnings call, equities call that also has to do with earnings, incidentally, the point that Hartmut was just making. Gautam Duggar of Motilal Oswal Financial Services expects earnings momentum to sustain, albeit the magnitude of growth is expected to moderate to 15% over FY24 to 26. He says the Nifty PE remains well within its 10-year average range and is expected to maintain this level going forward. They remain constructive on the market, and the preference is predominantly in favor of large caps, as valuations of mid and small cap indices are trading at a premium of 79% and 8% to Nifty 50, respectively. Their top large cap ideas are ICICI Bank, SBI, HUL, L&T, HCL Tech, M&M, Coal India, Titan, Hindalco, and Mankind Pharma. In the mid and small cap space, Gautam prefers Indian Hotels, Godrej Properties, Ashok Leyland, Persistent Systems, Kalyan Jewellers, KEI Industries, Metro Brands, PNB Housing, Cello World, and Angel One.
All right, well, there's some money market views also coming in. Abhishek Goenka of India Forex and Asset Management says markets had gotten too aggressive in pricing Fed cuts post the US jobs report, and some of those expectations have been pared now. He says volatility has subsided and risk assets have recovered and US yields have bounced back. The dollar made a comeback against funding currencies like the yuan and yen. He adds rupee has been stable around 83.95 to the dollar and has not recovered, which implies that overvaluation stands corrected. However, he adds, with forex reserves now at an all-time high of $675 billion, he expects the central bank will be in even better position to keep the volatility in check. He expects the rupee to trade between 83.4 to 84.4 over the medium term.
Okay, on bonds, Vishal Goenka of IndiaBonds.com says that low CPI number of 3.5% last evening looks good on the headline front, but much expected due to statistical reasons and the coming of exceptionally high spike last year at the same time. He says the RBI will look for more sustained lower numbers over the next few readings before its October meeting. He adds that we also get CPI numbers from the US tomorrow, which will be an important input for the US Fed in its September meeting, where only 0.25% rate cuts are expected as global macro volatility has already subsided. Vishal expects the 10-year benchmark bond yield here in India to trade in a range of 6.85 to 6.9%. In fact, since we're talking about the bond market and how it will react to that CPI number, let's straight away go across to Lata. CPI. So, Lata, I mean, at the headline, I think we all want to celebrate that we are finally below 4%. But will the market share this number as much?
It's only a headline celebration by the media, calling it 5-year low, because this 3.54 is largely because last year, July of 2023, it was 7.44. There was an unusual tomato onion spike, and that has, helped. This high base has helped this 3.54. But within this, there is reason to be happy. Not really to beat the drum, but to be happy that the market expectation was between 3.65 and 3.7. So to that extent, it's undershot the expectation. The even bigger undershoot is in food. Food, of course, was the one that was feared, 9.36 last month. That is for the month of June. But that's fallen all the way to 5.4%. Even here, the market poll that we got was 5.5. So it's a tad better than that. The big veggie inflation, which all of us feared, 29% in June, is now down to about 6.8 or thereabouts. So clearly, the worst of the tomatoes and potato inflation is behind us. We know that we have got an excellent monsoon. I believe the governors in the monetary policy speech said 107% of long-term average. So chances are that, pulses, which are still at 14% year on year, will also start slowing down, and, inflation will not be that big a pain point for the Reserve Bank. See, the important point the market will watch are the future numbers. In this particular policy, everybody knew that July is going to be low. So July, August, September, the forecast originally of the Reserve Bank was 3.8. But in this policy, they made it 4.4, which means they still believe that something could go wrong. There could be a rise in prices. So let's watch. If it way undershoots that 4.4 average, then people will start pricing in perhaps an earlier Reserve Bank rate cut. Just a word on the core inflation. That's jumped up to 3.4 from 3.1. Core is always sticky, but this again is a base. Last year for the same period, Jan to June, it was at 6% and coming down to 5. Now it will start going down towards 4. The base, 2023. So you will start seeing the core inflation inching up. But I think all told, the Reserve Bank's 4.5% for the full year is actually safe after the set of numbers we got in July. If anything, there is a small chance of undershoot. A word on the industrial output. We don't look at this number much because policy is not made on the basis of this number. It's only an input into GDP. Came in at 4.2, a disappointment because our poll and everybody else expected at least above 5% number. So this is a bit worrying. And within this, two things have done badly. Capex has done badly. That's come in at about 2.2 or something, 2.6. And consumer non-durables has come minus 1.4. If consumer is also, receding, and capex, of course, May, June, the government was not spending much. It was election time. Then you're a little worried whether the pace of growth will have to slacken a bit. But let's wait and see, early days.
All right. Lata, interesting sort of context to this entire data point and putting it in the right one. Thank you very much for joining us. With that, we'll take a quick commercial break here. Our list of top stocks to watch out for with the research team coming up next in just a bit.
Welcome back. Well, it's time to distill things down to stocks that we need to keep our eye on today. Our research team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, hi, morning. Rima, let's start first with the results. So Vodafone Idea in focus. How do those numbers look?
Well, the key highlight is the losses have come down for the company. So the loss this quarter at 6,400 crore is down 1,200 crore on a quarter-on-quarter basis and down about 1,400 crore on a year-on-year basis. The key reason is, remember, the company raised money via that FPO, and that has gone in bringing down their bank debt, and therefore the interest cost has come down for the company, and that's helped bring down the losses for the company. That said, it's still a big loss of more than 6,400 crore rupees. The second positive is, with that money raised, the company is upping its capex spend. So the capex spend this quarter at 760 crore is higher than what they did in the prior quarter. But the results of this are still yet to be seen. So the company's revenue growth continues to trail peers. Revenues have declined for the third consecutive quarter and are down close to about 0.9%. Margins are largely stable at about 40%. 4G subscribers have gone up, but the overall subscriber headcount continues to decline, and ARPUs for the company are largely stable.
Okay, all right, Rima, thanks a lot for that. Well, I'm looking at NMDC and I'm going with green on this one because the numbers on an operational parameter are better than what we work with. On the top line, there's a small miss. The EBITDA number is much better. The margins are much better. And in turn, the profitability as well is much better. Remember, we already have the provisional volumes with us. So, the realization is something that you're looking with. And the realizations on a year-on-year basis as well as a sequential basis are higher. The problem is, post the end of Q1, they have taken two large price cuts of more than 1,000 rupees, which will be on Q2 numbers. So for the time being, these numbers look good. Then how did they beat in terms of the margins? Because of royalty, since they produce less, the royalty as a percentage of the total sales mix, that came down to around 37%. Over the last many quarters, it's been between 41 to around 43%. So that's the reason that these numbers look better. But there are risks going ahead. For the time being, these numbers are better than what the street was working with. So let's move on then to a couple of more stocks. Vamakshi joins us to tell us about Hutco and IRFC. Morning, Vamakshi.
Well, good morning, Nigel. Hutco reported a good set. Therefore, I'm going with the green for this counter. In fact, there was a slight miss on the net profit, but that was mainly on account of higher interest costs. Disbursements came in at 12,625 crores for the quarter gone by. This is a rise of almost 19 times YOY, and this growth is largely being led by the disbursements in urban infra. Loan book saw an uptick of almost 30% on a YOY basis and has surpassed street estimates. NIMS, however, has contracted to 3% both on a YOY as well as sequential basis. Given the good growth in loan book, however, the NII is seeing an uptick of almost 12%. PPOP was up nearly 16% and net profit saw an uptick of almost 25%. The asset quality too has improved for the company by almost 29 basis points at the GNPA level and the NNPA came in at 0.33%. This is an improvement of nearly 3 basis points sequentially. IRFC, on the other hand, reported a decent set. The company was in focus yesterday after the cabinet provided a nod to the railway projects, but today it's in focus on the back of a decent set of numbers. Mild green is expected there because NII was up only 2% YOY, PPOP was up 1.8%. They had a provision write back of 3.62 crores as compared to a provision of nearly 50 lakh on a sequential basis. The net profit too saw an uptick of 1.8%. So overall, a decent set, going with a mild green for IRFC.
Okay, all right. Thanks a lot for that, Vamakshi. Getting back to metals then, Hindustan Copper, these numbers look good on a year-on-year basis. The problem is these numbers are backdated because as we have seen in the last 45 days or so, metal prices have come off substantially from the recent peak. And that's why the stock that was close to around 400 rupees has come down to around 300 rupees. Let's run you through the numbers first. On a year-on-year basis, good growth on the top line. EBITDA number more than doubled. And margins on a sequential basis are more or less stable. They've come off a little bit, but on a year-on-year basis, they look much better. The profit number as well, because of the higher operating profit, we are seeing that flows through. And the reason that the margins are a beat is because other expenditure has gone up by only around 8%, while the revenue has gone up by around 33%. So as a percentage of the sales mix, it's come down to around 38%. The problem for Hindustan Copper is that prices have come off and the stock trades at around 100 times its trailing earnings even as of now. So expect it to open up in the green, but from there it could give back some of that advantage. Going back to Rima though, Rima, focus on tech. Happiest Minds, how are the numbers?
So Happiest Minds, top line looks very strong. So the company's dollar revenue growth has increased by 10.9% on a quarter-on-quarter basis. This is on account of the two acquisitions, PureSoft and Aureus, that the company did. So that boosted the company's top line. EBITDA margins for the company have declined, on a quarter-on-quarter basis. But the way the company calculates margins is different because they include that other income. But the way we calculate EBITDA margins, it's down on a quarter-on-quarter basis by 160 basis points. Profits are down 29%. And here there are two reasons. One, there was an exceptional gain in the prior quarter of about 13 crore. And two, because of these acquisitions, the company has had to make certain non-recurring investments which have depressed the company's profits in the current quarter. But the top line growth is very strong on account of the two acquisitions. Back to you.
Rima, thank you very much for that. Well, the stationery product maker DOMS should also be in focus. Upasana is here with details. Upasana, morning.
Good morning. Thanks so much for that. Well, strong set of numbers reported by the company with a revenue growth of 17% on a YoY basis. EBITDA stood at 86 crores with an uptick of 38%, and margins also expanded sharply by 290 basis points at 19.3%. PAT stood at 54 crores with a growth of 50% on a YoY basis. Now, the company says that it continues to see momentum in sales growth and improvement in the margins going ahead. It aims to expand its presence in the product lines associated with kids, children and young adults. Hence, the board has approved an investment of 55.5 crore for acquiring majority stake in Uniclan Healthcare Private Limited, which is a company engaged in baby care and disposable hygiene care products. Company aims to enter a new range of products with this proposed acquisition.
All right, Upasana, thanks very much for that. So we'll watch out for DOMS. Let's look at some more earnings. We've got Mangalam joining in to take us through Senco as well as Campus Active. How were the numbers, Mangalam?
Well, for Senco, the revenue was largely in line with the first quarter update that the company had given. 11% jump in retail sales, 4% same-store sales growth. No worries out there. The EBITDA saw a 60% jump and the net profit saw an 85% jump. But here's the catch. It was led by inventory gains. So remember, during the first quarter, gold prices increased by about 10% and 5% of the company's gold inventory is unhedged. So they recognize those gains on that. In fact, going forward, this could be a bit of a problem because they said that reduction in customs duty will impact margins for the next couple of quarters. So while Q1 was good, the next couple of quarters margins would be impacted, and that's why I'm going with a red for Senco. For Campus Activewear, let's just say that this hasn't been a quarter for any of the footwear makers. Here, Campus wasn't any different either. 4% decline in revenues, 22% decline in EBITDA, and as a result of which there was a 20% decline in the profitability as well. The company did cite muted demand scenario across both rural and semi-urban areas, and add to that, even the average selling price declined from 629 rupees per pair to a little above 580 rupees per pair as well. So see some red on Campus.
Okay, all right. Thanks for that, Mangalam. Well, let's wind this down with Vivek, who's here to tell us about KPI Green and their fundraising plans. Morning, Vivek.
Well, good morning. KPI Green, we accessed the term sheet for this particular fundraise. So the route that they're taking is via the QIP route. The company is looking to raise close to 1,000 crore via this particular route. The floor price for this particular offer is at 983 rupees a share. The indicative issue price is close to 935 rupees a share. What does this mean? It's a dilution of 4.4% if you go by the base size of the deal. Dilution of close to 9%, if the company chooses to go ahead and exercise the upsize option for this particular deal. Going with the red on the back of the fact that it's a significant discount to the last traded price.
Okay, that's KPI Green. Watch out for it. But Vivek, hang on. We want to come back to you for another important update. But before that, quick recap of the top stocks to watch today. The ones that have positive news flow around them are Vodafone Idea, NMDC, Hutco, IRFC, Hindustan Copper, Happiest Minds and DOMS. Stocks with negative news flow around them are KPI Green, Senco Gold and Campus Activewear. Now, a lot of these stocks are earnings-based in terms of why we're watching out for them. There are going to be others which we will watch out for because of the MSCI index weight increases or decreases or exclusions or inclusions because the review is happening. So let's go back to Vivek for this. The August review is here. Vivek, tell us the highlights.
Well, that's right. So the August review is here. The list of inclusions and exclusions is out. India's weight in the emerging market index rises to 19.8% versus around 19.4% that it had as part of the May review. So the main index that we track is the MSCI Standard Index, where there will be 7 additions and 1 deletions. Which are the additions? Zydus Life, as per IFL Alt, expect to see flows of close to $218 million. Prestige Estates, we also have Dixon Tech, OFSS, Oil India, Vodafone Idea, as well as RVNL. Remember, most of the quant analysts actually had these names penciled in as likely inclusion candidates. 1 deletion is there from the MSCI Standard Index, and that is Bandhan Bank. Close to $109 million worth of selling will be seen. All of these changes will be implemented on August 30th, the trading session on that particular day. Another important stock that was on the radar ever since HDFC Bank uploaded the shareholding pattern, there was enough foreign room for MSCI to go ahead and increase the weight. along expected lines, MSCI has increased the weight for HDFC Bank, but they have chosen to do so in two separate tranches. So there will be close to $1,472 million or $1.4 billion of inflow on August 30th in HDFC Bank, and there will be another weight increase that MSCI will implement, and this will be done as part of the November review. Another important update, the Adani Group stocks are now, all of the embargo that was there on these stocks have been lifted, and now they will be treated, they will receive standard treatment as far as the MSCI list.
All right. Thank you very much, Vivek, for that. So that's an important list, and we'll talk more about this with an expert in just a bit from now in terms of implications for these individual names. But we'll take a break. We're back. Amnish Agarwal of Prabhudas Lilladher will be joining in for some specific stock conversation. Stay tuned.
Welcome back. Let's say hello to Amnish Agarwal, Head of Research at Prabhudas Lilladher. We have lots of stocks to discuss, many earnings to go over as well. Amnish, thanks for joining in. I want to start with Telecom because we've had interesting news over the last 24 hours. On one hand is this big investment into British Telecom that Bharti Enterprises is making. I know it's at the parent level, doesn't really impact the listed entity. But it's a big deal, right? $4 billion is what they're putting on the table. So that's one part of it. And then we've got numbers from Vodafone Idea, where the losses continue, but at least they're reducing. How do you look at these two stocks? Any interest here? And would the $4 billion investment by the parent, would that at all weigh on the listed entity, the India business here? Because so much money is being put to work, in terms of this overseas expansion.
You see, as it is in the listed entity, it is unlikely to have major impact on Bharti Airtel as such. But having said that, it also shows the confidence of the group in the overall telecom space, because earlier they had gone into Africa, now they are going into, say, UK. So I think the overall trend looks positive. And as far as your Vodafone is concerned, I think the losses are coming down, and I believe they are also looking at some sort of, you can say, adjustment or integration in their postpaid plans at slightly higher prices. So definitely the company is looking at, say, staging some sort of a turnaround in future. But definitely at the current juncture, Bharti Airtel has got much more visibility in terms of numbers in comparison to Vodafone. Vodafone remains dark horse in the sector.
Amnish, do you like insurance as a space? You know, the life insurance numbers came out yesterday during the last 2 hours or so of trade. We put the numbers out. It seems to be very strong. I mean, ICICI Pru, HDFC Life, SBI Life as well, although maybe the former two more. And it could be a sector for the day. Your thoughts?
You see, insurance, actually, if you look at particularly last year and a half, the growth rates have not been that encouraging. And particularly, I think HDFC Life, LIC, etc., they have given good numbers this time around. And if you look at, I think, barring, say, maybe an LIC, which was doing well from the last 12 months or so, the sector has been consolidating from last couple of years. And given the penetration of insurance, which remains very low in India, I think the sector can actually see some sort of more leg up or a re-rating from here on, given the fact that the numbers have started coming in quite good.
Okay, all right. Thanks for that, Amnish. Request you please to stay on, Amnish. Let's get in Mr. Vidyashankar Krishnan, the Chairman and Managing Director at MM Forgings. Hi, Mr. Krishnan. Good morning and thanks a lot for joining in. Well, for this quarter, the top line is more or less flattish, if you look at it on a year-on-year basis. But earlier when you joined us, you had given us some ambitious guidance for FY25. And I'll tell you what, sir, most of the street is saying whatever the management guides for, they should try to achieve it. So let's try to revise that guidance that you gave us earlier. You were talking about 1,800 crores of revenues with margins at around 20%. And also volumes at around 90 to around 95,000 tons. Any change in any of these numbers?
Morning, Nigel. So last time when we met to now, macroeconomic situations have considerably taken a turn for the, what shall I say, worse or a little bit tempered. So we are looking at marginal growth this year in the region of around 5%. So from around 1585, which we did last year, we would expect about 1650 plus this year.
Oh, all right. So that's
tonnage terms from around 85%, 85,000 tons, 84,000 tons to about 87 to 90,000 tons.
All right, so that's a skimming down of you're lowering your guidance because demand conditions have changed. We got that on the top line. Since you won't get the benefit of operating leverage that will play out, then could you tell us what impact will have on margins? Margins can hold around 20%, or is there a downside risk to that as well?
Due to cost reduction efforts that we are taking across the board, I would say that margins will hold at the 20% mark. We stand by our commitment to look at margins comfortably in the region of 20% from Q3, that is by end of this calendar year and onwards. So Q3 and Q4 onwards, margins should be up. Even for this quarter, if you look at it, the consolidated margins stand at 19.4% after removing other income, as against 17.7% in the previous quarter, in the corresponding quarter the previous year. So there's been a substantial improvement in margins due to considerable cost compression across the board. That will continue, and margins should hover around the 20% mark that we had guided a few quarters back.
Okay, all right, 20% margin, that's good. 5% revenue growth, 20% margins. Mr. Krishnan, hi, good morning. Prashant here. On the high tonnage press line, right, there was a lot of, there is a lot of expectation that this is the segment which will be the margin driver and which should contribute in a significant way. I think, could you give us a sense of how this is looking? What the outlook here is?
Yeah, sure. Largely, the high tonnage press line serves the CV market, which right now is quite range bound, and we hope that along with our CV OEs, that that H2 will be much stronger. Now, what we've also done on the high tonnage line is to add a 16,500 ton press, the largest of its kind in the world. So this press will come into production in the next 12 to 15 months, and into commercial production in the next 12 to 15 months, and is expected to bolster our capacity by around 25,000 tons per annum.
You know, I'm reading a note which essentially said that you can achieve a top line of between 1,800 to 2,000 crores in the next 2 to 3 years here in this segment. Is that a fair assumption?
I wouldn't say not in this segment alone. Overall, we are looking at, of course, much bigger numbers over a 2 to 3 year time frame. This segment would be around 50%, so about 1,500 crores approximately over the next 3 to 5 year time frame.
All right, Mr. Krishnan, final question before we let you go then. Do you see any downside risk to these numbers that you're giving us? You've already scaled it down, but do you see that? Point number one. And point number two is on the EV revenues for this year, what are you forecasting?
This year, we will make our initial debut on the EV. Let me first look at the guidance numbers first. So we expect these numbers to be, whatever we have discussed now, to be reasonably held right through the year. Of course, we have to always remember that we are not a market maker. We are what shall I say, followers of OEs and the market itself. So subject to reasonable macroeconomic conditions as we see them today, I would say that these numbers should hold. Next, on the EV play, we are moving ahead. This year, we will clock our initial sales, and next year, we will hit double digits.
All right, 100 crores this year, 25?
Sorry?
100 crores this year in FY25, EV?
No. Double digit next year. So this year we will open our account.
Okay. All right. Fair enough. So we'll leave it there. Thank you very much, Mr. Krishnan. Appreciate you joining in with that. Well, let's just sort of turn our attention back to the markets. And there's, 15 minutes to go for the market to open, the pre-open session, that is. Anuj is here with what he's making of things. Anuj, good morning.
Morning, Prashant. A crucial day for the market. And that's because, while yesterday you respected the support levels, clearly there's some resistance at higher levels. The Nifty has been sort of oscillating in the range between support and resistance. Now, there was 20-day exponential moving average hurdle that we faced yesterday. In fact, for 2 days now, the Nifty's top has been exactly the 20-day exponential moving average. Now, 20-day MA is the most important market level in terms of positional trades. So it will be interesting to see whether we take that out or not. Today, of course, we have 2 Qs to negotiate. Inflation data, which on margin is positive, and MSCI changes in HDFC Bank, which on margin is negative because the market was expecting perhaps all the changes to happen in one go, and it's been divided in two particular tranches. And the Nifty IT also is at make or break juncture. So in that sense, you have 2 big index today, Nifty Bank and Nifty IT, which would be at crucial levels. In terms of Nifty levels to watch, the first resistance is 24,400 to 24,450, the last 2 days peak, and also the 20-day exponential moving average, and then 24,500 to 24,600 based on the options data. Support comes in at 24,200 to 24,250 based on the options and yesterday's low, and then the big support is 24,000 to 24,100 based on the charts. The Bank Nifty, I think that trade is now all about 20-day exponential moving average and 100-day exponential moving average. The 20-day is placed at 51,100. It's a big resistance. And 49,850, which the Bank Nifty has defended all through the last 4 or 5 days. The 100 EMA, that's the support level. I leave you with the quote of the day, and it's an interesting one. Happy Tuesday. Got to admit, it sounds better than Happy Monday.
I think it's putting it quite simply, and very directly. Thank you, Anuj, for that. So we'll watch out for how things progress as we get set for the open. Back to our conversation with Amnish Agarwal. Amnish, what's your sense on some of the jewelry stocks? They've had a fantastic run up until now, but I think for the next couple of months, we'll all watch out for this inventory impact, courtesy the customs duty cut, and even Senco is guiding for that. Even Titan spoke about the inventory hit in the quarterly call. What's your sense? Would you be buying any dips on the jewelers?
You see, what has happened is that there has been this structural change. So I will not call it just as a duty cut, because what has happened with this 6% import duty is that the entire, you can say, the your illegal trade or the smuggling of the gold becomes unviable at 6%. So that actually puts the, you can say, all the organized players at an advantage in comparison to the illicit trade in the country. So that is one. Now, secondly, any which ways, the first half of the year was likely to be muted. 1Q was weak. And in 2Q also, we don't have, you can say, many festivals. And towards the end of 2Q, we have got the Shraddh season, which usually is a weak time for the jewelry buying. However, what has happened is that due to the cut in the import duty, the gold prices have corrected, which has resulted in some sort of improvement in demand at the ground level. And I don't rule out this as a preponement of demand also. So whatever bulge in demand we were expected in 3Q, some of it has got shifted in 2Q. In the longer term, it's a positive move. And I think we would be buyers in the jewelry companies on any correction or declines.
All right. We'll take a quick commercial break here. There's a lot more to discuss. The implied open is indicating a 20-odd point lower start. We'll take a break. We're back. Amnish is with us, but we'll also address technicals and specific trades with Mitesh and Sudarshan in just a bit from now.
Welcome back. As promised, let's get to our technical experts. We have Mitesh Thakur and Sudarshan Sukhani who join us on the show. Good morning, gentlemen. Thanks a lot for joining in. Well, the GIFT Nifty is suggesting a 20-point downtick. How do you approach trade, Mitesh? You go first.
Good morning, Nigel. So, a couple of observations before I go into the immediate view. I think one, we came down from 25,000 plus levels to 24,000 sub levels and then bounced back, and you've just done about 50% of the retracement at 24,485. I think we are still not showing that signs of, getting past the important hurdles at higher levels. So one, in the short term, the sell-on rally trade remains. The good thing is that the resilience at the lower end, which is one, the support pivot levels being developed at 24,000 and then 24,200, and the put open interest data also suggests that some put writing is happening around those strikes. So it might be a choppy and volatile market, but since the medium term indicators have started turning slightly negative, I think I would be slightly more biased towards selling on rallies or else trading on a stock specific basis.
Got that. Gentlemen, morning. Sudarshan, what about you? How would you approach things today?
Yeah, good morning. Well, the market is in a trading range, and inside a trading range, because we are in a larger uptrend, the trade is to buy on dips. We got that dip on Thursday when we wanted to buy, and yesterday. Today, we've had 2 days on which dip buying was successful. I don't think it's going to work today. So for today, when now we are talking about the short-term trend. For today, the trade is to avoid doing anything in the Nifty or the Bank Nifty. Individual stocks, of course, will be available, but I don't think there is any trade in the indices today.
Okay, so in that case, let's talk about those individual stocks. Gentlemen, good morning. Sudarshan, let's come to your list first. What are you working with today?
Sure. JSW Steel is a buy with a stop under 860. Similarly, M&M Finance, which is going into a large trading range and hopefully will break on the upside, is a buying opportunity with a stop under 285. ONGC, which is already in a strong uptrend, has a consolidation. That's probably a pause before another up move. That's a buy with a stop under 310. My only intraday short is Godrej Consumer, which can be considered for an intraday short with a stop above 1500. You know, the larger bias is still long for stocks.
Okay, all right. So keeping the view constructive over there. Mitesh, hi. What are you buying or selling today?
See, I have more of sell calls. A sell on AU Bank with a stop at 621 for targets of 585. Godrej Consumer features on my list as well. Keep a stop at 1411 for targets of 1350. And second FMCG stock is Nestle. So I think after a good rally, FMCG is showing signs of correction. So Nestle is a sell with a stop about 2500 for targets of 2410. And LIC Housing Finance is a buy. Keep a stop at 624. Look for targets of 675.
Okay, all right, gentlemen, thanks very much. We'll come back to you closer to market open. Right now, need to take a very quick break. We'll come back on the other side. We'll have the pre-open rates, and also we will get down into a conversation with Balrampur Chini. The company came out with its first quarter numbers. Mr. Pramod Patwari, CFO of the company, is going to discuss the outlook going ahead. Welcome back. So we've got the technical trades for the day. Let's also look at some ideas on the futures and options side. We've got Avani Bhatt, Senior Vice President, Equity Derivatives Research at JM Financial Services for that. Avani, good to have you on the show. So tell us, what are the stocks you're working with?
Good morning, Sonia. I have two stocks for today. If you notice, the pharma sector has been performing very well. In spite of all the volatility, all the pharma stocks are making newer highs and giving newer breakouts. So one of the stocks that has given a good breakout yesterday is Glenmark Pharma. After almost 15 days of consolidation, the stock has moved up above the resistance zone of around 1480 on good volumes and an open interest addition of around 3% in futures. So I think the stock is heading towards 1600 in a very short time. So we'll initiate a buy call on this particular stock, Glenmark Pharma, in the range of 1500 to, if at all you see some price retracement, up to around 1490. Stop loss can be kept at 1455 and target would be 1600. The second stock that I feel is from the IT sector. The IT sector has seen a decent 10% correction from the highs, and is now showing a good piercing bullish candle formation on the daily and weekly charts. One of the stocks that I like from this particular space is Infosys. Infosys, once the gap down resistance level of around 1816 is crossed, we should see a decent up move in this particular stock. So we can initiate a buy call in Infosys. It closed at around 1797 level yesterday. The targets on the upper end would be 1850 to 1880, and stop loss can be kept at 1755.
All right, Avni, since we have you, very quickly, if you could tell us on HDFC Bank, that's going to be the big one to track today. the MSCI rejig announcement hasn't really come according to plan, though it's not very disappointing as well. Levels you're tracking on that one, how would you approach that stock?
Yeah, good morning, Nigel. So HDFC Bank, technically it has given a good breakout and it is trading above the 200-day moving average. Even the short-term moving averages of 50 and 20-day moving averages. So I think if at all we see any kind of retracement up to around 1640, that should be a good level to initiate longs in spite of all the disappointments. Technically and on derivative parameters, the stock looks absolutely robust and after some bit of consolidation and time correction, it should head towards around 1750 to 1780 levels very soon.
Okay, Avni, we will leave it there. Thank you very much for joining in. So some F&O trades for the day. Let's now move on and get a conversation going with Mr. Pramod Patwari, CFO at Balrampur Chini Mills. The company came out with its numbers just a while back. And in terms of the top line growth, it's been slightly flattish. Just about 2% growth is what the company has managed. The EBITDA margin is fairly steady at around 11.7 odd percent. Mr. Patwari, good to have you on. Let's start with the the sugar segment first and talk about the top line growth. I think you're absolutely flat compared to last year at around 1,130 odd crores. Can you just tell us how much you did in terms of volume, what is happening with pricing, and also an outlook on both volume and pricing, considering that we're very close to a brand new sugar year starting?
Good morning and thanks for having me on the show. So sugar revenue is a function of quota release, which the government of India does on a month-to-month basis. So our revenue from the sugar segment derived primarily on account of that. As far as the current realizations are concerned, we are selling sugar at around 38.5, and for the quarter gone by, the average realization came at 38.90. For the new sugar season, which is going to begin on 1st of October, our in-house view is that country will begin with an opening inventory of around 8.5 million tons. We are expecting that this year government will allow production of ethanol through juice and BAB route in an unhindered manner. And our view is that diversion of sugar into this can be in the region of around 4 to 4.5 million tons. If that we take that into consideration, the net sugar production as per our view for the upcoming sugar season should be around 30 to 28 million tons. So if you add 28 million tons with an opening of around 8.5, that leaves us with an available inventory of around 36.5. Against that, the domestic consumption next year should be around 29 million tons. So we are still left with 7.5 million tons of inventory, which is decent enough. And the normative inventory which the government has considered in the past and were extremely comfortable was in the region of around 5.5 million. So still there is a scope of 2 million ton of surplus inventory, and government might consider export at some point in time.
That's exactly the point that I was coming to, sir. I think the industry has been really crying out for some easing up on the export front. Now, we don't know. I mean, are you expecting that policy to change anytime soon? And if it doesn't, let's work with what we have right now. If exports are not opened up in any more meaningful way, and if we continue to have this kind of buffer stock and the surpluses, then what should be the expectation on pricing? Because on the cane side, obviously, we're seeing, FRP going up, and there's been the MSP hikes as well. So on pricing, what should the expectation be if we assume that there's no change on the export front for now?
So maybe at the cost of repetition, I would like to say that sugar price in the country will also depend upon the availability of sugar into the country. As we have painted a picture of around 2 million ton of surplus sugar, even after considering a diversion of around 4 to 4.5 million ton of sugar into ethanol, I think government would like to see the progress of the monsoon and the yield of the crops, maybe sometime post the commencement of the crushing season, and then they would take a call on the export front. As far as the future pricing are concerned, domestic availability of sugar is sufficient and it is balanced. So we don't see a very runaway in the domestic prices from here.
All right. Pramod, hi. Good morning. Prashant here. On the ethanol front, just this weekend, we had Mr. Amit Shah, the Home Minister, essentially talking about bringing forward the 20% petrol ethanol blending to FY26 as compared to 2030, urging sugar cooperatives to sort of increase production, etc. So what is, I mean, are you expecting anything on that front in terms of pricing, etc.? Is all that is settled?
So good morning, Prashant. This 20% blending target is nothing but a reiteration. Reiteration was already pre-formed in 2021. So government is looking at a blending of around 20% in 25-26. Sugar industry can easily supply 50 to 55% of the total requirement, which will be required for 20% blending. And as per the Niti Aayog document, for 20% blending, the requirement is around 1,000 crores liter. For the pricing, yes, we are still awaiting the revision of ethanol prices for the last year. But this year, as the government is looking for a meaningful diversion of sugar to happen into ethanol, I think the proper pricing will be set at some point in time.
No, it should happen now, right? I mean, anytime now, or
yeah. So the ethanol year begins from 1st of November. So still there is a time.
Okay, and what would you expect the pricing to be at?
So if we take a relation of last announced price of ethanol vis-a-vis the FRP prevalent at that point in time, we get a conversion ratio. So we would be comfortable if government restores the same conversion ratio going forward also.
Okay, all right. Pramod, thanks a lot for joining in. We would like to understand more about your PLA project, but that discussion for another time. Thanks a lot for joining in and filling us in with all of those details. Well, let's focus on the big announcement that came in overnight, the MSCI rebal. We have Sriram Velayudan of IIFL who joins us. Hi, Sriram. Good morning. Thanks a lot for joining us here on CNBC-TV18. Well, on HDFC Bank, the disappointment is that this rebalance will be done over 2 tranches, not 1. So my question to you is, what is the potential inflows, stock price impact in tranche 1? And is there any risk to tranche 2? Because back of the envelope calculation suggests there is unlikely to be one. Go ahead.
Yeah, hi, Nigel. Good morning. So largely the market expectations centered around the weight up happening in 1 tranche. But now what the index provider MSCI decided is they will be implementing it in 2 tranches. In the first tranche, we are anticipating inflows of roughly $2 billion, which is around 3 days of volume impact and roughly 6 to 7 days of delivery impact. So what I believe is $1.8 to $2 billion is still significant. I definitely wouldn't consider it as a negative. Stock might see some a weakness as such to start with, but I believe it should gradually recoup. As I said, $1.8 to $2 billion is still on the higher side. It's not lower by any means. Now, what caveat the index provider has added is they will be evaluating the foreign room in HDFC Bank. Let's say the foreign room falls below 20% weight up, but the second tranche of weight up would happen in the November review. Now, what I think is I will assign a very high probability of the second tranche of upweighting happening as well, because the foreign room coming off to below 20% would entail 6.5 to 7 billion worth of FPI buying, which I believe is on a high side. Okay.
So, Sriram, so HDFC, the impact is going to play out in 2 parts now. And I think you mentioned about 1,800. That's the figure that we're working with in terms of the money coming in. You think much of this is already factored in the stock price? Obviously, when the eventual money flows in, we'll see that kind of impact. But going forward, how do you expect the stock to shape up, given the technical event and the next one now in November?
Yeah. So looking at the positioning aspect here, so in terms of open interest stock on the futures like HDFC Bank on the futures like carries an aggregated open interest of roughly $3.5 billion. All of it we cannot consider as prepositioners. So when the month began, it has roughly added 150 to 200 million worth of open interest, which again is on the higher side. So as I said, 1.8 to $2 billion is still on the higher side. It's not lower by any means. So from with due respect to fundamentals, the weight up event should have a positive impact in the name. Because I'm assigning a high probability for the second tranching also to take place in the November review.
Sriram, any other stocks which should see action? Zydus, Prestige, Dixon, or you think most of this is already in a way played out?
Prashant, most of the names have played out because the 7 additions were largely in line with the street expectations. It's factored in according to me.
Okay, all right. A quick word on the Adani Group stocks as well. MSCI has lifted the embargo on them. How do you read this?
Yeah, so in another development, MSCI finally decided to lift the embargo on the Adani Group names. For the last 1 year, the index provider was not incorporating the shares and float changes with respect to Adani Group. In a welcome move, they have lifted the freeze that they had in place for the past 1 year. So in terms of stocks, Adani Energy Solutions will be there on radar. I think it's a very healthy probable for the November MSCI reval event as an inclusion potential.
Adani Energy Solutions, okay. So that could be on the radar. Overall, Sriram, I mean, I don't know if you have the numbers back of hand right now. What would be the weights of all the Adani entities put together right now on the MSCI indices? And if you would expect that to change at all, I mean, if you expect any changes in the near future, now that at least the freeze is off?
I don't have the figure at the back of my mind. For this reval, the float factors are getting lowered, at least for this reval. Because as I said, the index provider hasn't touched the float factors and share changes in the last 1 year.
All right, Sriram, we'll leave it there. Quick conversation, but useful as always. Thank you for joining us here with some of that. We're just going to look at the pre-open rates, the Nifty and of course, HDFC Bank is down about 2%. It's flat as they come, unchanged almost. It's like where we left off yesterday. HDFC Bank is what I'm talking about. We're showing a 2% cut. And of course, some of the other MSCI changes. But as Sriram said, most of it is played out. There is, a pre-positioning in anticipation of what may come. Then there is the actual positioning. And then, it's like very, very widely and closely followed. All of these sort of passive changes because the numbers are very, very large in terms of flows in some cases. So lots of interest, lots of money to be made. But by the time we get to this stage, a lot of it is done. As Sriram pointed out. Well, let's bring in Sudarshan back again for the 9:10 call. Sudarshan and Mitesh, gentlemen. Sudarshan, you go first.
Well, consider buying ONGC with a stop under 310.
Okay, ONGC surged yesterday as well. Mitesh, what about you?
I'll go with a sell on next day and look for a target of around 2410, 2400.
Okay. All right, gentlemen. Thank you for those quick calls. By the way, the pre-open rates all have settled and the market's absolutely flat in the pre-open. Nifty is not going anywhere, just about 4 points lower. That's what we have. It's the pre-open Nifty. Let's quickly look at Aarti Industries. This is a stock that could be in focus as well. Sonal, what are you looking at?
Well, Aarti Industries reported numbers day before yesterday. It was a good set, but the management held a conference call yesterday post-market hours, and they did not indicate a possibility of meeting their guidance. In fact, they went ahead and said that they will be able to decide or freeze onto guidance of 1,450 crore rupees to 1,700 crore rupees of EBITDA only after they get some sense of what's happening in the global scenario, because there's a lot of volatility in margins and pressure from China as well. However, they have maintained their volume growth guidance of 20 to 30%. In terms of demand, say they discretionary segments such as the dyes and pigments witness continued recovery and sequential growth as well. However, the Red Sea issues, they are impacting freight costs, and that is something that could impact their volumes going forward as well. Debt stands at 3,300 crore rupees, and this could reach levels of 35 to 3,600 crore rupees because of the capex they have planned. Now, in terms of brokerage, Morgan Stanley has an equal weight with a target price of 615. They say an evolving product mix, which is foray into energy applications as well, is something which is leading to margin volatility. MK says they have a buy rating with a target price of 800. It is the fourth consecutive quarter of sequential recovery. However, because there is no clarity on EBITDA guidance, they've cut their FY25 and FY26 EPS by 11 and 5%. Nuvama says they are raising the target price to 903, but that is because they're rolling forward their estimates to Q1 of FY27. Agrochemical segment shall see recovery in the second half of this fiscal, but their freezing of their EBITDA guidance is something that the street wouldn't like.
Okay, all right. Thanks a lot for that, Sonal. Well, let's hop across to Mangalam. He's here to tell us about Bata and Honasa. Mangalam.
Well, both those stocks are on our radar on account of Goldman Sachs notes. So Goldman Sachs has actually downgraded Bata to sell. They've reduced the target price from closer to 1,500 to about 1,300 rupees itself. And they've cut the next 3 years' EPS estimates by 17, 12 and 10% respectively. Why is that? Because they don't see any levers for major growth in same-store sales growth, which has been negative to flattish over the last many quarters. And the company is guided for mid to high single digit. They don't see any reason for the company, for the performance to come like that. In fact, even the EBITDA margins are unlikely to reach FY20 levels, even for as long as FY27. So that's why they're negative on the stock. Honasa, on the other hand, they've initiated with a buy rating and a target price of 570. Why is that? Because there are two major trends taking place right now. One is the shift of sales to e-commerce, and secondly, the shift to active skincare products, science-based skincare products. And they believe Honasa will benefit from that. In fact, they expect the revenues to double 2.5 times and margins to double as well.
All right. Thanks very much, Mangalam, for that. Right on cue, we've got market opening absolutely flat. Yeah, flat. 10 points down, 24,333. The sensex is down 100 points, 79,550 is where we are at. So this is the opening neither here nor there, but certainly a bit sideways is how we've started. Market breadth, though, it's too early, but it's 1350 up and about 400 lower. And some of the other indices, Nifty Bank is down about 50 odd points as well. But all about stocks, so let's get to it.
Absolutely. So if you talk about the large cap screen, some of the movers and shakers, Apollo Hospitals, which is reporting numbers today, is right on top. The banks are looking not too bad. Axis Bank, ICICI Bank, all on the upside of the screen. Let's see what HDFC Bank is doing. HDFC Bank is down 2.5%. The disappointment is really playing out because this weight increase is not happening in one go. It's being split now, August, the next one in November. So there's some disappointment playing out there. Because of that, the Bank Nifty itself is under a bit of pressure. But back to looking at some more names, Britannia, JSW Steel. These are stocks on the upside. L&T starting positive. Hero Motors reporting numbers today. So that stocks are starting out with a mild green as well. On the flip side of the screen, some of the auto stocks are in for a bout of profit-taking. Tata Motors, Bajaj Auto, M&M. So, yeah, even iShow for that matter. So, auto is not looking too hot at this point in time. And, of course, HDFC Bank is keeping a lid on the gains as well.
Well, just focus on Ola Electric. What a dream start, right? First trading session up 20%. Yesterday up 20%. And today as well up another 15%. Ola Electric, that's flying away, catching everyone's imagination as well. Lucky for those that got allotted in that particular issue. Other stocks are in focus. This renewable energy theme has come back, and it's come back in style. Inox went up close to around 10%. Big up move is what we are seeing. We had the management yesterday. They sounded very, very optimistic on business prospects. The street is taking note of it. Last week, we had Suzlon Energy. That management as well, talking up the stock, talking very, very positive about the execution for the remainder of this year. So that one as well up close to around 5%. A couple of other notable movers today. You have Hindustan Copper. Well, that stock is holding its own, up and about in today's trading session. Those numbers are good. Yes, there are risks for the coming, coming quarter. But for the time being, the street is grabbing onto those numbers. That's why that's up. Dixon as well up close to around 2.5%. You have the Adani Group stocks actually that are doing well. So you have a couple of them that are bounced back. Case in point being an ACC that's up close to around 1.5%. So keep an eye out on that one. Ambuja Cements as well. I think the first tick was in the green. What's taking it on the chin? Well, it's Aarti Industries because of that guidance, because of the street is a little bit skeptic whether or not they can achieve what they've set out for the year. So that stock's down close to around 8.5%. But Prashant, HDFC Bank, that's trading at the 20 DMA. That inflow in the first tranche itself could support the stock at current levels. I guess it's in for a bit of a time correction.
Absolutely. And, we've got the biggest gainer, which is biggest volume-led gainer for the third straight session, which is Ola Electric, right? So 40%, add 15 to that. So it's a big one and tremendous interest, as you can see, right at the at the market open with these kind of volumes. So absolutely. Suzlon is the second biggest volume-led gainer, although, I mean, that is changing a little bit, but it's now the third, 4.5% higher. Stocks at about 85 now. We had the management of Inox Wind yesterday, with stock ended up 15%, add another 10% this morning to it. Inox Wind has got, is number 2 in terms of volumes on the NSE, 226 on Inox Wind. and look at it fly. Nigel mentioned the Adani Group stocks. Adani Energy Solutions is up 4. Adani Total is up about 2.75%. I mean, these are the two I can spot. Olectra Green Tech is up 6%. Again, it's backed by volumes. Inox Green also had a pretty good day yesterday. It's up another 3% right now. We had the management of Balrampur early, but Bajaj Hindustan is the one which is up about 3%. Jyoti Laboratories is up 4%, 584 on Jyoti Laboratories. You'll hear from the management of Senco a little later. Senco is up 6%. We highlighted DOMS and the numbers there, 2.5 on DOMS, that's a stationery maker. And I can go down the list, but then volumes are lacking. This is essentially the bulk of what is moving and moving sharply. On the downside, I think we've already highlighted Aarti Industries. RCF is down about 2%. Happiest Minds is down 2 3/4. Gensol is down about 2%. Global Spirits is down about 4%. But that's it. I mean, there's not too much volume on the downside, at least right now. Surabhi?
Prashant, just mentioning that Aarti, now the cut is almost 10%. So the fact that the management is not too confident of maintaining the guidance, that's really playing out on the stock. Uflex is the other one that's down about 4-5%. In terms of disappointing result reactions, Yatra had a really tough quarter. Not a great performance from Yatra, down about 4-5% there as well. Tilak Nagar Industries is a reaction on the upside. Those numbers have worked well. And by the way, on Adani Energy, I think like Sridhar was just saying, now there's some excitement building up that since the MSCI is willing to look at these stocks again, maybe at some point in time, it starts getting the benefit in terms of the indices, global indices.
Unembargoed, so to speak. I don't know if that's a word. But, just put up LIC. Actually, the life insurers. LIC was down 5% yesterday on the back of earnings. And it was went on a large volume. LIC is not recovering. It's flattish. But let's look at ICICI Pru, HDFC Life and SBI Life. Just wondering if there's any reaction at all. Stocks have done well last quarter. Nothing. HDFC Life is down about a half. ICICI Pru is absolutely flat. I don't think SBI Life is doing very much as well. Two or three other accidents yesterday, right? Bharat Dynamics sold off 10% yesterday. If Balakrishna Industries maybe comes up on your screen, these were all down very sharply. BDL is down another 1. Balakrishna Industries will come up. Sun TV is another one which was down over 10% yesterday. So, just looking at some of these
check Ola
names
Electric,
right now.
Nigel.
Yeah.
Just see, I mean, I know 20%.
It's come off from the top.
Exactly. So it's a very interesting trade on, and some profit taking perhaps.
The brakes being put on that one, after having 20% on each of the 2 days, I think some kind of rationality is coming in there. But one more stock, Stovecraft, just take a look at that stock. Yesterday, the stock did well. Today, it's put on another 5%, or I'm not sure whether the analyst call was post-market as. But after sounding positive, remember, it's been one of the underperformers. The numbers are now showing and the management is optimistic. So it seems the street is taking note of that.
Yeah, absolutely. And, the other one was Voltas from yesterday, right? I'm not sure if you should actually see if there's any follow-through. But that one on your screen is opening flat. All right, well, let's welcome in our market master, Rahul Arora, CEO at Nirmal Bang Institute Equities. He's with us right here. Rahul, great to have you with us here. Good morning. Thanks very much. How are things looking? And let's start with Ola, and if you have a view. Almost 50% in today, the third day, and it's listed live. What do you make of it? Have you do you have coverage, first of all? And thoughts?
So, morning. Thank you for having me on the show. And I think at least from a market perspective, Prashant, it takes me back to a line that Nawazuddin Siddiqui said in Sacred Games, Kabhi kabhi lagta hai apan hi bhagwan hai. It just seems like nothing can break the market at all. You thought, Fed rate hikes would break the market, wars would break the market, crude would break it. The BJP losing elections would break it, long-term capital gains tax would break it. Nothing has broken this market. So the question some investors ask is, ab tak nahi toota, to ab kyun tootega? So that, I think, at some level is smacking of complacency. It may come out of nowhere, as you saw with the yen carry trade incident, but that also got bought into. I think that has shocked me more than the shocks that would come from Ola Electric, But too early to make a comment.
By the way, even with Ola, some were saying at the margin that, the historical relation, very large IPOs and what markets do when you got, it just got absorbed.
I think those days of DLF and Reliance Petroleum are long gone, Prashant. I think that the markets were much shallower then. But I think specifically on Ola, not a comment yet because it's just listed. We haven't really penciled in. Obviously, it's going to be something that we do track. But I think pockets of the market, there is a huge amount of sector rotation that's taking place. There's no question about that. But I think after each of these 4 or 5 incidents that I spoke about, whether it was the election results or LTCG or the yen carry trade, I think at various points value has certainly emerged. The market was getting very excessive at certain points in time. You were discussing certain defense names. It's heartening to see that they're coming off because things had become very irrational. But at an aggregate level, I'd still say if you were to look at the Nifty earnings projections for the next 2 years in terms of growth, because I think most of the margin expansion is done, Prashant. The focus is now going to be on the top line. So you're probably going to be looking at about a 13-15% kind of earnings growth for the Nifty between 24 reported and 26 actual. I think that should be your expectation for the market return as well. I think people should not lose sight of the fact that the Nifty was 7,500 not too long back, and it's more than tripled in a matter of 4 years. So I think at some level it's going to rationalize. The bond markets will come into play at some point with the inflation numbers yesterday, and I think the Fed talking about rate cuts will be interesting to see how the back end of the year comes up with respect to the 10-year. But I think that could potentially be a play as well. So I wouldn't be very gung-ho at this point in time. I think earnings expectations is what's going to sort of drive market expectations, but have reasonable expectation of about 13 to 15% kind of returns compounded over a 5-year period. And I think that will probably be in line with what your EPS growth will be.
Rahul, I'm just thinking Sacred Games also had another line, right? Sirf Tiwari bachega. So I think in the global market context, we all know which market is a Tiwari over here. But to go back to your point, I mean, since you are not very gung-ho and there is sector rotation, what do you incrementally buy? I mean, I know the argument gets made on FMCG every time, and every time there's a scare in the market, you'll see a little bit of a gravitation towards that side, but it's not building up in any sustained way. Because if you're talking about top-line growth, then we all know, I mean, right now, I think the best in case is being sort of a mid-single-digit kind of a number is what you can get. So should one be looking beyond this and go where others have not gone in the last 2 years? How do you play the market?
No, so I think the easiest call is BFSI. I think about 3 weeks back when we were doing Editors Roundtable, we did a piece on insurance companies as well. But I think overall BFSI is still presenting value. As I was telling Prashant a little while back, I think once we get into a rate cut cycle, I think you'll probably get into a situation where the incremental fight for deposits on the rate front will abate. So I think pressures on NIMs will ease. You guys were discussing HDFC Bank at market open. They showed a 3 basis points sequential improvement in their net interest margin. SBI's valuations still look very attractive. I mean, for an 18% ROE, bank still coming to you at 1.5 times book. Bank of Baroda, although missed estimates, is trading at under book. And I think if you looked at, I just go back to another stock that Prashant was highlighting in LIC, just look at the insurance numbers yesterday. Look at what the private sector has done on individual APE and group APE, including the new business premium. I think 25 to 40% growth for all the large companies, including Max Life, which is predominantly a mid-cap. I don't think valuations are out of whack. I think 2 times price to embedded value for iPru Life and SBI Life, 1.3, 1.4 for Max. And I think housing finance companies could be interesting. LIC Housing Finance was a miss this quarter in terms of results, but we like that space. We recently initiated on Housing Urban Development Company, HUDCO. We like that name. So I think BFSI valuations are not demanding at all. IndusInd Bank again coming to you at 1.5 times, Axis at 2. It's a clear overweight sector for us. Consumer Surbi, not really. As you rightly pointed out, 50 plus P for most of these stocks for a 3 to 5%. And let's not forget, Surbi, if you juxtapose VMart's results to this, you'll understand that there was probably an election play here. So that volume number that you're seeing of maybe 3%, 5%, even 8% in the cases of, say, like a Godrej, for example, I don't know how sustainable these numbers are. So to be paying 50 Ps right now for these, I'm not sure. I think FMCG has had a good run. Most of the stocks are up 25, 30% from the May results. At these prices, I would be tempted to play banks as a clear overweight, and maybe cement could be the other overweight blanket sector that we play.
By the way, I just want to clarify, our producer, Mr. Tiwari, has pointed out the line was not Tiwari bachega, it was Trivedi bachega. So just clarifying and,
All right, Rahul, let's take that discussion forward then. Since you briefly mentioned cement, what do you like out there? The large are getting larger. There was this time when everyone wants to buy the stocks that are at a big discount to the EV per ton. But if you look at actually the larger players, UltraTech Cement has been one of the biggest outperformers. What's the view? How do you approach the space?
So I think, Nigel, consolidation is going to be the name of the game when you're looking forward. I think there are eventually going to be 5 or 6 major players that stand. One is, of course, going to be Adani. The other will be UltraTech. Dalmia will be one, Shree Cement, and I think you'll probably have some consolidation in and around the JK group, maybe Ramco. So I think everything else will probably get subsumed into these 6 in one way, shape or form. I think given the fact that crude has been stable for a very, very large period of time, broadly between 75 to 85, and I think if you look at coking coal and pet coal prices, they've been off from the highs that we have seen by almost 25 to 35% from the peak that we saw. I think that there is a case if volume growth was to, of course, it's not been that good yet, but if you get into a situation towards the back end of the year post-monsoons where you have 8%, 9%, maybe even 10% volume growth for some companies on a weak base, then you could look at a play at EBITDA per metric ton going to about 1,000 or maybe even higher than that in some cases. I think if you look at ACC Ambuja combined, which is eventually the reality, it's going to happen at some stage. I think that looks like an interesting bet from the large cap space.
Okay.
I think if you look at the mid cap space, we like Ramco. I think there is still at least another 20% game that's probably left there. And JK Lakshmi from the small cap. So if I was probably taking one, to answer your specific question, one large, mid and small cap, it'll probably be the ACC Ambuja combined in the large cap, Ramco in the mid and JK Lakshmi. Birla Corp has had a good run. You know, the Mukutban facility is up and running. I think that could be an interesting dark horse as well. So let's not forget the first order the Prime Minister signed when he took office for the 3rd time was a housing order. So I think that is going to have a second order impact on cement demand. And I think especially in the case of ACC Ambuja, there's a lot of backward integration, railway sidings, etc., which I'm sure is well spoken about. So I think these would probably be the 3 top ideas in cement at this point.
Ramco is going to be interesting, right? Because suddenly you have a lot more competition in South India. Some of those plants that were functioning at almost zilch, you know, they're going to be ramped up. So it'll be an interesting play, though the stock has come off a little bit from the top. But we take that point. Since we mentioned real estate, what do you like out there? Just take a look at some of these stocks. I mean, we had some debate whether or not the tinkering in taxation was good or bad. The stocks, but have seen a big recovery post that budget, eh?
Well, there was obviously, to be fair to the finance minister, that clarification that came in. So I think to that extent it was all right. But I think, Nigel, incrementally from here, I think commercial and retail look relatively more interesting than residential because, you know, I think there's been a huge run up in real estate stocks and demand. I think, you know, whether you were a DLF who picked up $1 billion in a weekend or at the bottom of the pyramid, you know, some NCR developers, some unlisted ones who I don't want to name, have picked up 300-400 crores in a weekend when they've launched. So I think that kind of demand is a little unsustainable, to be very honest.
Okay.
You know, you could look at names like Phoenix Mills. I understand St. Regis's results were not all that hot for the quarter gone by, but Phoenix looks like an interesting one. Nesco could be a fairly interesting one. You know, I think with the entire business district that's even Suntec is planning to put up in that part of Bombay, I think, you know, and incrementally there is some talk about the auto show, which has predominantly been in Pragati Maidan in Delhi, probably moving to Nesco. So I think retail and commercial could be relatively better placed, even from a yield perspective. And I think, you know, if you want to play it as a proxy, you could even look at playing it through REITs, right? So whether you look at Embassy or a Mindspace. So I think that looks like an interesting space, but not. I don't know if this run in real estate on the residential side can continue unabated.
Okay, all right. We'll leave it there. Rahul, great conversation as always. Thank you so very much for joining us. It's a pleasure speaking to you. The market, by the way, is flattish. We're down about, what, 25 points. And I mean, 321 is where we're at. Just a few more names. Hindustan Copper is up about 4.25%. Stocks at about 315. It was not there in the mix in the morning as we started. Triveni Turbine is another one, which has got about 4.5% gains. We did mention Stovecraft. It's up a little bit more. It started 5% high. It's up 8.5% now. And there are some of these smaller names. BL Kashyap, a Delhi-based contractor, and I mean, so, you know, it's broadening out and market breadth is looking good. 1,300 stocks are higher and about 1,000 stocks, just under 1,000 stocks are lower. But Nigel, Senco is up about 6% as well, or just about 1,100 right now.
I think before Senco, we have the management of Hudco joining it. And that's also a company that came out with numbers over the last 24 hours or so. The first quarter was a good quarter for the company. AUM growth came in above estimates. Asset quality also improved, and there's been healthy business momentum. We have Mr. Sanjay Kulashrestha, Chairman and MD of Hudco, now joining in. So good to have you on. I'm looking at the basic numbers to start off with. Now, disbursements are up about 23.5%. I mean, if I look at it quarter on quarter, year on year, of course, the numbers have really surged. Your loan book quarter on quarter is up about 12%. Year on year is up about 30%. So let's start by first mapping out the expectation for the whole year, what is the kind of loan growth that you're working with? And, how is cost of funds shaping up? What about margins? What do you see ahead?
We had planned our fiscal year very diligently, and you can see in the first quarter itself, we had started making on those steps. The disbursement has, as you have rightly pointed out, we had already crossed around 13,000. In comparison to the last year, quarter one, it was just in hundreds. And similarly, in the pipeline also regarding sanctions also, we had penetrated across the infrastructure. You can name it, like from road to housing, to energy, to water, to power. So everywhere we had started our footprints, and we are emerging as a good institution for infrastructural support for our agencies, and which in turns will become an roadmap for the Viksit Bharat. So we had started on the same lines, and we had taken an internal target of around a disbursement of 35,000 crores. And looking at the sanctions and the pipeline, I think it can easily be achieved. In the meantime, I am very happy to share that Cabinet has already approved PMAY 2.0, and HUDCO has a good role to play in terms of the lending and in terms of the consultancy. So this 35,000 crores of the disbursement, I look at from the very conservative figure for this fiscal, and very soon things will be evolved and the guidelines will be out of the PMAY, and HUDCO will be the beneficiary of all those initiatives of the government of India, and we will be happy to support all these initiatives of the government of India.
So with disbursements of 35,000 crores this year, what will be your total AUM growth? I mean, how much will the book grow overall? Are we talking, 10, 12, 15%? If you could just give us that percentage growth for the overall book.
See, for next two fiscal, by FY26, we had planned that our loan book should go by 1.5 lakh crores. Last year it was 92,000 crores, and during first quarter we had already crossed 1 lakh crores. So during this fiscal we have a target to achieve 1.2 lakh crores, and it is coming out at the CAGR of 25%. And if you compare from the last fiscal, quarter one, we had grown around 30%. So we will be growing in first few years at the CAGR of at least 25%.
Mr. Kulshitra, just to go back to that PMAY scheme, which was sort of cleared over the weekend, just this weekend. Morning, Prashant here. Are you still waiting for any details? Because I think there is an interest subsidy component as well. We have some specific details here. How is this? Has this been done in a much better, more expansive way than before, than the first round?
Yeah, definitely. Actually, the Government of India continue to work towards the improvement and the increasing penetration of the PMAY. Last PMAY was a historic movement by the Government of India, and this PMAY will go ahead with the same intent and the intention, but of course the penetrations will be much higher. And there will be a CLSS program also, there will be a PMAY grants and grants to the state government, and it will come in a very penetrating way. So I'm sure that the guidelines will be available within a week or so, and we are waiting for that. And as we discussed that housing is a main portfolio of the HUDCO, so we will remain be the beneficiary towards the state contribution. And last PMAY also we had contributed around more than 22,000 crores in our loan book, and this PMAY, since this program is of 10 lakh crores and around 2.2 lakh crores being provided by Government of India to the states, then there will be a requirement of the counterpart funding to the states. And this will be a much bigger program, since we are talking about around 3 crores households. So you see, once we talk about 3 crores household, last time it was 1 crore. So this will be a more penetrating and more pointing and more customized form of PMAY, I'm sure.
So will this fast? You're saying FY25 you should be able to disbursement should be easily above 35,000 crores, right? Could this provide a the PMAY 2 provide a much sort of sustain this momentum going forward for the next number of years? What's the expectation? How will this help? How much incremental help from this?
I think since the requirement to the states will be to the tune of 7.8 lakh crores, in next 2 to 3 years of the time during the implementation of the PMAY. Some of the amounts the states will be raising through the internal accruals or the STLs, but definitely there will be a good appetite for HUDCO, and we had taken the first mover advantage, and we had been advised to be ready with the guidelines, and I think we are ready to get into the PMAY 2, and the loan disbursement will be higher towards the housing sector because of the PMAY in 2 to 3 years of the time. In first year, since very conservatively we had planned our disbursement at 35,000 crores, but I think we have to revise our figure in maybe in the November or December, looking at the pace and the absorption starting of the PMAY by the states.
Can sense the optimism in your tone,
definitely
sir.
It will be on the higher side.
Yeah, congratulations. It's been a good start and you're sounding reasonably optimistic as well. Just want to reconfirm, the loan book by the end of this year will be 1.2 lakh crore by FY25?
Yes.
1.2, all right. So we'll get that.
It is very diligently planned to become 1.2 lakh crores.
Yes, and 1.5 by FY26.
FY26. You are right.
Got it. Let's clear out a couple of other factors then. The NIMs, well, they came off marginally. They've come to around 3% odd. So what's the outlook on the NIMs? If you could tell us, whether the cost of borrowing has moved up, point number one. And the second factor is, what kind of resolutions are you working with for this year? Please go ahead.
Yeah, actually, the company, there are three mantras of the company. One is the start penetrating and expanding its loan base. Second is resolving the stress assets, and we have stress assets of totaling to around 2,500 crores, and we had started resolving those stress assets. During last FY also we had resolved few, and during first quarter also we had resolved around 3 stress assets, and we will continue to do so, and our internal target is to resolve all the stress assets by FY26. Around 1,500 crores of the stress assets are under different stages of resolution under NCLT. So we will be aggressively pushing those resolutions along with the other consortium partner. And third is the cost of funds. So cost of fund front, we had worked extensively during last 1 year, and we had tried the international markets in terms of the loan. We had gone for FCNR, we had gone for bonds, we had gone for domestic bonds, and we had tried how to reduce our cost of funds, and we had been successfully reduced weighted average cost of fund from 7.75% to 7.57% in these hours of the higher interest rate regimes. So during these times we are continue to work, and the mandate and the commitment of the company is to have an infrastructure which is more viable, more sustainable. But yes, of course, we will be taking care of our spreads and the NIMs, and the NIMs will remain in the range of 3.3 to 3.5%. And during this time, it has reduced slightly because the growth momentum is higher. Because of that, there is a slight downward on the NIM, but we will be continue to take care of the NIMs at 3.3 to 3.5% level. But if you reduce our EBR, that is around 20,000 crores, which is a fee-based income from us, then our NIMs are in the range of more than 3.5%. So from our loan assets, they are at 3.5%, but if I include the EBR, it is around 3%. But definitely we will be stable at around 3.3 to 3.5%, and similarly the spreads will be in the range of 1.6 to 1.8%.
Sir, just on the point on NIMs in this first quarter dip, I noticed that while your cost of funds has been coming down, as you explained, the yield also came down a little bit, which is why I just want to understand the mix in the loan book. How much right now is pure play housing and how much would be large projects? I mean, I'm looking at the details here. I think you've signed a MOU for a Surat integrated transportation development, I think multimodal transportation hub. You've signed up with the Rajasthan government for infrastructure projects of almost 1 lakh crore. So you're doing a lot of the infrastructure and urban development work as well. So what's the mix in the loan book and which is the higher yielding business, just to understand how yields will move?
Presently, our housing portfolio is around 42%. It is at 42,000 crores. And because of the PMAY, there will be a push towards the housing business. And we had already stopped our hardcore retail. So we are not into the retail business since the banks are also there and the good rates are being extended to the customers. So we had withdrawn from that market. We will be there to support the affordable housing and economically weaker households to the state government. And this product, because of the PMAY, will have a lot of takers from the states. And this is backed by the state, and this is for the social sector. So this will be a good penetrating and branding product for the company. At the same time, if you see, our main cash earning projects are, we had started funding to the companies who are more profit generating type of companies. We are moving away from the state government guarantees and the budgetary allocations, and we are looking at the project which are self-sustainable, as you have rightly pointed out, like Surat. And all these good entities and the good projects demands a very competitive kind of pricing. So, we as a Government of India company, which is 75% owned by the Government of India, we will remain committed towards creation of the sustainable infrastructure. So,
but competitive. We got it, sir.
That we have to cut down our.
No, got it. These are high-profile projects. These are, as you say, you want to work with good entities where your payouts happen on time, but then bidding is competitive, and that explains that minor dip in the yields coming through. Thank you very much. It was a very good conversation, and we wish you good luck for the rest of the year as well. So that's HUDCO. But Nigel, one more management up next.
Well, that's right. Let's focus on Senco now. For Q1, their revenue growth was in line, while the gross margins also expanded. The management says that the reduction in customs duty will impact their margins for the next 2 to 3 quarters. To understand more about that, we have Mr. Suvankar Sen, the MD and CEO of Senco Gold and Diamonds, who joins in. Hi, Suvankar. Good morning, and congratulations on a good show. Well, the stock is glittering. It's seen a big up move in the last few months. So shareholders will be happy, but they'll want to know more about it. So let's focus first on the reduction in duty. What is the extent of the impact on margins we could see in the coming quarters? And also in the near term, there'll be a bit of a hit because of inventory loss. Could you quantify that? We had spoken to Titan, and they as well had spoken about this. So for your company, what is the impact likely to be?
So happy morning to everyone. Our results have come out, and I must be very excited to inform everyone that while yes, the top line growth that we've seen has been about 7.5% in a consolidated manner, and the retail growth that we have seen is about 9%. But the profits have grown by the PAT has grown by almost 85% for Q1 compared to the last year Q1. But again, at the same time, we must see that compared to Q3 of last year and Q4 of last year, the margins, the EBIT margins, the EBITDA margins that we have seen has been in the same line. Q1 has been a challenging quarter in terms of, with the heat wave, with the elections coming in. So therefore, maybe the top line could have been better in a different situation. But we had focused on ensuring that we look at the quality of margins, the hedging mechanism was in place, and therefore there was a normalization of profit. We had opened 4 new stores, a company-owned company operated 2 franchisees. So all of it put together, the quality of the growth was good with all the controls in place. And in terms of the current situation that we see post the cut in duty, I must tell you that, first of all, it's a great move by the government that the duty has been cut, because it did boost the consumer sentiments, and there has been a lot more excitement, especially with the wedding season that is coming in Q3 and Q4, that upper middle class consumers can now feel like buying gold. Initially, they were thinking that it was not in their reach, but now we can see higher footfalls at the stores. So at one end, yes, there will be an impact on the inventory valuation, which we feel that to the range of 50 to 60 crores that can get distributed over the coming 2 to 3 quarters, because it will not take a hit on the single quarter. But at the same time, the expectation of higher growth compared to what we have been seeing in Q1, and our focus on increasing all kinds of products, including diamond jewelry, which would give a little higher margins to the company. So the effort is all there to ensure that whatever hit we will be taking can be compensated by other efforts and initiatives.
Okay, Suvankar, hi, good morning. So 50 to 60 crore over the next 2 to 3 quarters, right? Spread out.
Yes, yes.
Is the impact. You did touch upon diamonds. I mean, we just spoke with you in July, so we have some of the numbers, and we'll sort of reconfirm whether you're on track for all of that. You should be. But on diamonds, there were some reports which were coming through in the recent past talking about how Sales are suffering, some sort of manufacturing and polishing units shutting down. Is that seasonal in nature, or is something happening at the ground level where demand is kind of tapering off? We are entering a busy period with all the festive season all the way into the end of the year. So you have that tailwind, but underlying as far as diamond demand is concerned, what's going on?
So what's happened is, like, for example, in Q1, we have seen that the diamond sales volume have come down by about 3 to 4%. That is for the for us and the Indian domestic industry. But more importantly, we must remember that diamond is an integral part of the exports revenue for the country, for the industry. And looking at the global scenario, when you look at the US, when you look at China, when you look at Europe, with all the wars and all the global uncertainties, the global demand has come down. We are already looking at US recession in place and unemployment happening. So these are the reasons that is leading to the fact that the slowdown happening in the industry, and the demand has been down. Plus, for India, what we have seen is that whenever there has been a big jump in the gold prices, immediately that has its own linked impact on the diamond jewelry purchase also, because consumers' budgets are limited. So while we can always try to convert it from gold to diamond, but then gold is a component of the jewelry, and if with prices going up, consumers think that, okay, let us wait, there is no hurry, we can wait and buy it later. So that's the overall, putting everything together. Plus, we have seen that, yes, because of the slow demand, the diamond prices have also been under pressure, especially the bigger size diamonds, above 50 cents and 1 carat. And that is leading to certain pressure on the industry, and prices are coming down. Demand is not as much as the supply is. So that's the reason they have decided to withhold and shut down factories for the time being.
Suvankar, just want to sort of get your sense, because there's so many moving parts, right? The price itself has gone up, gold price, but then you have the duty cut that's come through as well. Now, as we get into the peak festive season, like for like, and I know it varies a couple of weeks here and there, but I mean, if you go like for like, what is the projection that you're working with? Because even last year, I remember it was quite a bumper season. Now, as we get into festive/wedding, looking at the inherent consumer demand, would you expect flattish growth, build up 5-10%? Just give us something to work with.
Right. So see, it's actually, as you said, there are so many parts to this movement. So say, for example, last quarter, we had a growth of 7.5% in a consolidated way, and around 9 to 10% in a retail way. Our aim and objective is to have a 18 to 20% growth. Now, with the first quarter that we have finished off with, I must inform and let you all know that because of the duty cut, we have seen a huge increase in footfalls. And that growth that was kind of slow in terms of top line in the first quarter is being compensated by the sudden increase in growth in the quarter 2, and quarter 3 is anyway a festive season. So we also just had our, the India International Jewelry Show that happens annually every time, where consumers and retailers, not consumers, retailers and manufacturers are all coming together for preparation for the coming season. And there has been a very good demand. So I think that this Q2 and Q3 will be very good. And with our expectations and the objective with which we are working on a growth of 18 to 20% for the year, I think we will all work towards that and try to achieve that target.
That's the top line growth number, right? FY25 top line growth 18 to 20%.
Yes.
All right, so Suvankar, let's get a couple of quick numbers out of the way. Studded ratio, what is the recent quarter numbers for last year?
So Q1 because of the slowdown and the fall of diamond volumes, the studded ratio has come down to about 9.5 to 10%. So
and where is that number headed?
And that number, our aim is to take it towards 12.5, 13% for this financial year. So that's how we are working on Q2 and Q3.
All right. Thanks a lot, Suvankar, for joining in. The stock's glittering as we speak, and going by that guidance, 18 to 20% growth. Your shareholders will be quite happy as well. Appreciate you joining in. For the time being, though, we'll slip into a short break. On the other side, we'll get chatting with Jupiter Life Line Hospital. Stay with us.
Okay, welcome back. We're continuing our corporate conversations here, and we're going to sort of move on to the hospital space. We have Ankit Thakur, Chief Executive Officer at Jupiter Life Hospitals, and they're with us now to talk about numbers. Ankit, great to have you with us here. Thank you very much. You've reported a steady set for the first quarter. Occupancy has surged to 64%, and average revenue per occupied bed has also improved. So, Ankit, let's start talking about which of the three hospitals has led to the bulk of the improvement in matrices, and if you can give us a sense for each on both the occupancy and the average revenue per occupied bed.
Right. So, good morning. Thank you for having me. On the occupancy front, yes, on the blended level, we have about 64% this quarter, with Thane and Pune being more matured facilities. Thane is reporting about 70% occupancy in the quarter, with a ARPOB of about 67,000. Pune, we just added some beds last year. We have added 22 more beds on 1st July this year. So it has a little expanded base of capacity. Currently, it is reporting 63% occupancy with around 59,000-60,000 of ARPOBs. And Indore is at 57% occupancy currently, which is our newest facility, about 3 years old, with an ARPOB of 46,000.
All right. Hi, Amit. Good morning and good to see you in. What's the guidance on ARPOB from here on? You're close to around 60,000. Where is that number headed?
So I think for Thane and Pune, we'll probably just see inflation-linked growth in ARPOBs. Whatever is a good number according to you for inflation, 4, 5, 6, 7, whatever you want to plug in, could be plugged in for Thane and Pune for ARPOB growth. Indore, along with inflation, also has a little bit of scope for increase in ARPOB based on case mix optimization. So Indore should see a little faster growth in ARPOB. Over and above inflation.
Got it. Let's get a couple of crucial numbers from a stock market perspective, since we have understood, the ARPOB as well as the current occupancy. Last year, you grew by 20%. For this year, give and take everything, you're adding some beds as well. The mix is changing. What kind of a growth can you deliver for FY25? Point number one. And I think in the next few years, you're looking at taking the margins up by around 200 to 300 basis points towards around 25%. But for the near term, what should that number look like? Will it stay in this vicinity of 22 to 23%?
So, in terms of margins in hospitals, it is kind of a natural life cycle. It is not that I'm trying to do something or I will pull a rabbit out of my hat. It is an evolutionary process of a new hospital. With Thane and Pune being matured, we believe that a matured hospital should deliver something around 25% of margin. Indore being new and still, kind of not really there, it has a little bit of dilutive effect on the margin. So once Indore also starts, moving into that matured zone category, then even on a blended level, you should see mature margins that is around 25%.
Okay. Got that. So it's a good way to think about it. So let's talk about the new hospitals, right? The Dombivli Hospital. Could you provide us with a status update? And you've acquired land to build another one in Pune. So that'll be the 5th one. Right. Just a status update there as well.
Yes. So Dombivli, the construction is on. We have pretty much come on the ground level. The basement construction is over, which is about 30% of the building. We are on track as far as construction in Dombivli is concerned, ready to start operations maybe end of next financial year, beginning of the year after. Pune, the land is signed. We are under planning and regulatory approval stage. We believe in the next quarter or two, we should have all the permissions under our belt, and we should be able to begin construction in Pune as well. Both these hospitals are going to be 500-bed hospitals.
500 each, right?
500 each, yes.
Okay. So, and this would be up and running by, what's the timeline?
So end of 26, beginning 27, Dombivli, 1 year after Pune.
Okay. And by then, what would be the total bed capacity?
So once all these are on, then we'll be at 2,200 beds.
Okay, 2,200 beds by once the Dombivli and the Pune hospital are also up and running. We've got, Ankit, just coming to you. We've got the first listing, two listings on your screen, and I think both are looking like good listings. First Cry is listing, and so is Unicommerce eSolutions. The rates will come up on your screen, and we'll have the first sticks. Yeah, they're good listings. 46% on First Cry. Unicommerce, of course, much smaller. I mean, in terms of I think about 1,000 crores or so, and 130% higher. So small issue, but it's a super duper listing. So it's doubled, basically, more than doubled right to the first stick, 250 rupees. And of course, the issue was subscribed in a very large way. First Cry, to maybe some would be a bit of a surprise, that has got a super response as well, which is 50% higher. You'll be able to sort of hear from both the managements during the course of the day. We've, by the way, spoken with them over the last fortnight, but of course without specific numbers. But now today, you'll be able to hear some specific numbers in terms of what the growth, etc., is going to look like for both these companies. So there you have it. Two new listings coming through this morning. Ankit, just to come back to you. So for the full year, F5, just near term, for the full year F525, what kind of top line growth should we expect?
So first quarter, I think we have about 17-18% growth in top line. It seems to be holding on. Yeah, but I think the year should hold on.
Okay, around 17-18% growth for the full year as well. We'll leave it there, Ankit. Good conversation. Thank you very much for joining us here on CNBC-TV18. That's Jupiter Life with some perspective on the business and numbers going forward. We'll take a quick commercial. Okay, I think we'll bring in Mitesh now to run us through what the picture on the charts is looking like. Mitesh, welcome back. 20 points lower, neither here nor there. Is there anything to do on the indices, or you'd want to go straight to stocks?
Prashant, what I'm possibly observing on the index or indices is that the bank nifty could turn weak again. I think that's the one which is actually moving a bit more than the nifty, and I'm waiting for a break below 50,250, 50,300 zones. And once that happens, I think then we can look at 50,000 being tested and then maybe lower levels. So the bank nifty is the one which I'm keeping a close watch upon. On the stock side, Dixon is a buy. Keep a stop at about levels of 11,750. Look for targets of 12,600 plus. And on the selling side is Dabur. I think, FMCG does look like giving a stronger pullback. So Dabur is a sell on a trading basis with a stop at about 630 for targets of 600.
A cash stock, Stovecraft, the high was in the listing year, which is 2021. I think the high was 1,150. This year so far is, actually this week has been great for the stock. 730-ish on the charts. Does it catch your attention, catch your eye?
In fact, I was planning it yesterday. The stock started making new highs yesterday, and today there's a good follow-up happening. So the first target should be around 800. If you go back, possibly a little bit in the history, on the 7th to 9th Feb, there is a big gap down around 800, 825 level. So that should be the first target. We might see some supply and profit booking over there, a breather and a top. But I think eventually it will clear that and head higher. So very, very bullish long-term charts here. But for short-term swing traders, position traders, I think around 800, 820 would be a good zone to take profits.
And, just two other names. Sun TV, Mitesh, down another 3% after yesterday's 10-12% cut, if you want to weigh in. And any of these defense names, I think Cochin Shipyard is down 4. I was highlighting Cochin Shipyard. The recent high 10 days back was almost 3,000. Stocks are about 2,200 now, but again, has had a one-way rally. BDL has been weaker. Some of these defense names, PSU defense names, on the shipping side otherwise. Any thoughts here?
So, Prashant, I think, one, Sun TV, I think, we had actually a buy-side call which got triggered out below levels of 865, 860. And the fall has been very, very strong in the last 2 days. That is yesterday and today. So I think while there is some pivot support around 780, the stock might actually decline to about 750 zones as well, given the way the force with which the fall has started. So there could be some more declines over here. And on these defense stocks, I think, they had an amazing, I think, last few months, and the last 2 weeks, we have seen first signs of correction coming into the chart picture over here. So I think Cochin Shipyard, my first target is around 2100 to about 20 on the downside. I think around those levels, you might see the stock come down and then consolidate before it makes another attempt to move up. Similarly, Mazgaon Dock, I think, once the stock starts breaking below levels of 4800, there could be a bit more decline, and that could be to about levels of 4350 to about 4300.
Okay, all right, Mitesh got that. It's an out-and-out mid-cap day. The headline index is absolutely flat. It's all about mid-caps. Blue Star is having a good session, 5.5% up. Keynes is seeing buying 5% higher. Inox Wind, there is absolutely no stopping. It's another 10% on Inox. Electra's numbers were very well received. Electra Green Tech, 11% up on that counter. Lots of things. Gujarat, Pipavav, Senco we've discussed. So, it's a very, very interesting looking and very alive and kicking mid-cap and small-cap screen. That's the market for now. Let's take a break. We'll come back on the other side and actually put some thoughts in and get you a spotlight on some of these buzzing stocks. Welcome back. Well, plenty of stocks on the move, as we've been telling you. Let's start with Aarti Industries, which has been reeling under the impact of the management saying that it may not be able to meet its yearly guidance. Sonal is back with us. Sonal, fill us in on the details.
Well, Aarti Industries was one of the companies which saw fourth consecutive quarter of sequential recovery, and there was a hope that it could be one of the first chemical companies to come back to growth prospects after that weakness that the entire sector saw as well. So the street is now surprised by the fact that this is the first company who's saying that they might not be able to meet their guidance that they had given for EBITDA, which was between 1,450 crore rupees to 1,700 crore rupees. They're talking about margin volatility, the impact of Chinese pricing pressure. So that is something which has worried the street. However, they talk about volume growth being at 20 to 30%. They stick to their guidance as they had given earlier. In terms of demand, they say discretionary demand in dyes and pigments that continues to improve. However, agrochemicals demand that will improve only in second half of FY25. In terms of exports, they do have a sizable portion going there. They talk about how higher freight costs could impact volumes in some of the segments that they operate in. So that is another comment which has worried the street. They have a debt of around 3,300 crores right now. They have a capex as well. So it could see a peak debt of around 3,500 to 3,600 crore rupees. Now, brokerages, they are surprised. Morgan Stanley has an equal weight rating with a target price of 615. They say an evolving product mix where they are getting into energy applications as well is driving higher margin volatility versus what the company saw earlier. MK says that they have a buy rating. This is the fourth consecutive quarter of sequential EBITDA recovery, which the street was betting on. But now, because of this uncertainty around margins, they have cut their FY25, FY26 EPS by 11 and 5%. Nuvama is raising the target price, but that's a rollover that they are taking. But agrochemical segment will see a recovery only in the second half. They have a buy rating. Kotak says that it has suspended FY25 guidance because they're acknowledging market volatility. They retain their sell, but they say the guidance that they have going forward is also subject to demand and pricing volatility. So they are also not very sanguine on the stock.
Okay, all right. Thanks a lot for that, Sonal. Well, I'm looking at Hindustan Copper, and the start has been in the green because on a year-on-year basis, the numbers look good. So on the top line, there's a growth of close to around 30%. The EBITDA number has doubled on a quarter-to-quarter, on a year-to-year basis. And on the margin performance, on a sequential basis, it's more or less stable. It's come off a little bit from around that 39.5% odd mark, the margin number. But on a year-on-year basis, it's much better, holding at around 38%. If you compare it, it's with a like-to-like number of around 25%. What caused this big surge in terms of margins towards the upper end of 30%? Well, two factors. One is copper prices on a year-on-year basis are still much higher. The second factor is other expenditure is up only around 8% when you have a top-line growth of more than 30%. So as a percentage of sales, other expenditure is only around 38% in comparison with around 47%. The profit number as well gets a bit of a booster shot because of better operational performance. The problem for Hindustan Copper is that, copper prices have come off in the last 45 days or so. And on a trailing multiple, it trades at around 100 times. There's big scope from here on. The problem is the global space itself has got a little bit nervous. So for the time being, the stock is holding up with a gain of around 3.5% odd.
Okay, all right. So that's Hindustan Copper in focus. With that, we do have to take a quick break. We'll come back on the other side with our special segment, It's the Economy. Lata will get chatting with Harsh Vardhan of Bain & Company to talk about falling bank deposits and the outlook ahead for the sector.